right? So the trade is being analyzed by different people, which simply means at the end of the day, for you to get the results, it may happen that if more people in the world, if you and other people in the world are making good decisions, right? Right? That is what is going to help you. So at the end of the day, that is what you need to understand. That once you become a trader, you should know that it is a battle not with only you, it is a battle not only you, but then the whole world, right? Everyone is engaged in that journey with you. So let's assume you are a sports trader or futures trader, to which I'm going to take time to explain the two, right? Now, whatever kind of trader you find yourself, you are not the only such trader in the market, right? About billions of people, okay, are also in the same market. About billions of people are also in the same market, right? So you need to also understand that since billions of people are also in the same market, you are going to make decisions with such people. And mind you, such an maybe brilliant man, you have high intelligence, maybe you are so small like myself, you are in your own corner and you want to make decisions which will tally with a nationwide people, number of people in the world, which will tally with billionaires mindset, which will tally with poor man's mindset, which will tally with the average man's mindset. My brother, once you win, you should know that you are a winner indeed. And if you fail to, you should know that you are not a failure, because the fact is that it is not easy to compete with the world. So sometimes in your competition with the world, you may win, and sometimes in your competition with the world, you may lose. And that is the game of trading, right? That is the game of trading. Now let's come to our case. In the case of crypto trading, we have different forms of trading, like the spot trading, futures trading. We have even arbitrage, okay? Arbitrage trading. We also have staking. We also have in fact P2P sports. In fact, there are many, right? More than 15 forms of trading in the crypto markets. More than 15 forms of what trading. Even NFTs are also forms of what trading. And all these forms of trading takes important part of the market, and each and every trader may find himself in one part of this market or the other. Are we following? Right? So in the case of you becoming a trader, it is your core responsibility to understand your specialized area in the market, and how you can take time to grab the concepts and then also make good profit out of such markets. So talk of futures markets and then also sports markets. Now, when we talk of sports and futures markets, I guess you can see my screen, or let me give you a clean dashboard. Let me give you a clean board. Okay, so let me give you a clean board so that you can see things clearly. Okay, so now in the case of sports and futures, in the case of sports and futures, right? What you need to understand is this: sports is the mother trading, which is beginner friendly. When I say is the mother trading, now sports market stands out of all the markets. And for you to even understand futures trading, you should first understand sports trading. Well, there are some people that knows how to trade futures, but they don't know how to trade sports. But then the basics of all trading is the sports trading, which involves low risk and also beginner friendly, right? So when it comes to sports trading, The easy way, that the reason why we've been saying the spot market is beginner friendly and also the easy forms of trading is that on the spot market, the risk level on the spot market is very low as compared to the futures market. That is the first thing that you need to know. Secondly, on the spot market, when we say the risk is low as compared to the futures, the reason being is that on the spot market, trader does not loses money. The spot market is all just about you having the opportunity to first buying assets at a low price, selling it at a higher price. So it's about buying and selling. B/S. You buy, you sell. Now, in every market, even in our traditional markets, we perform what we call buying and selling. We buy assets, we sell assets. We buy land, we sell land. Right? You go to the market to buy something of your choice. Maybe you may be a retailer or a wholesale trader. Right? So you, the retailer, you go out, you go in market. If maybe you are selling in Ghana, we call it FOS. Those who sell clothes, second-hand clothes, we call them FOS sellers, right? So maybe you go to market to buy those FOS in bulk. That is to come and sell them at a different price. So you go to the wholesale market to buy them and then sell them at different prices. At the end of the day, your mission is to make profit. So when it comes to the digital market too, the mission on the spot market is to do what? Is to buy assets at a lower price, sell them, and then make more profit for yourself. Now, in the process of doing that, the reason why we keep saying the spot market is a low risk market is that at a point in time when you buy an asset on the spot market, since the market is subjected to what we call volatility, since listen, I assume that this particular class is beginner friendly, so I'm going to take time to explain things one after the other before we venture into how to set up, right? So on the spot market, the market, though the crypto market is subjected to what we call a volatile or volatility market, okay, which is a market that fluctuation, right? The markets fluctuate and we all know that. And due to this, markets may have the opportunity to rise very high, and also the same market that rises very high, it may also rise or drop very low. Okay, it may drop low because the market follows what you call demand and supply. Demand and what supply, which is one of the key economic concepts. Which is one of the what key economic concepts. Which this rule of demand and supply mostly says this: when more people begins to buy something, okay, the price becomes expensive. Okay, when more people begins to buy something, that is to the layman's understanding, when more people begins to jump on something, the price becomes expensive. When the price becomes expensive, people begin to sell that particular asset or products because now the price is expensive, and those who got the opportunity to buy it at the least price would make more profit, and as a result of that, they'll begin to sell it. Do you get it? So in as much as right, so in as much as most of these people are being able to do what, are being able to make profit, they will now think of how they can sell their assets. Now when more people are selling the assets, the price becomes very low. That is what we call it supply. Right, that is what we term it as what, as supply. Do you get it? So that is the simple rule of demand and supply. That is a simple meaning of demand and supply. So when more people are buying the asset, the price becomes expensive, and when the price becomes expensive, they begin to sell it. More so, when the more they sell it, that is what it creates what we call supply, because the price becomes very cheap. And when the price becomes cheap, people begin to jump on it again. And that is the same rule the crypto market also follows. Right? So the market decide that that is a reason why. Let me give you a typical example. That is a reason why you see the crypto market decide that, for instance, BTC. So you see BTC, immediately BTC creates a new all-time high. When we say all-time high, that is ATH. That is the highest price of an asset. The highest price of what? Of an asset. That is the meaning of all-time high. Its highest price that it has been able to get or reach. So let's assume BTC now get to 125,000 US dollars. Immediately the price gets to 125,000 US dollars, then now you begin to see that the price begins to dump again. So anytime an asset creates all-time high, the price begins to dump. This simply means market does not always goes up. It goes up, it comes down. So there are people who have targeted these assets. Mind you, before this asset will go to 125, someone was already having that asset at 118, 118, right? 120, right? 122. So immediately all these people they begin to make profits. Now, once it gets to 125, this person need to cash out. This person need to cash out. This person also need to cash out. So you, the person who bought it at 125, what will happen to you? What will happen to you? At that point in time, you bought it at 125. It's simply the price is now beginning to go down against you. So you may be running at loss. So in the case of this, if you are a sports trader, in your case, your responsibility is to wait, because mind you, the person who bought it at 118 also needed to wait, and he waited enough before the price reached 125 before he cashed out. Are you enjoying the session? Are we learning? Are we learning? Are we learning? Are we learning? Let me know if you are enjoying the session. Let me know if you're enjoying the session. Hmm? Let me know if you're enjoying the session. Hmm? Very good. Very good. Now we can proceed. Since you are following, now we can proceed. So, looking at this particular rules and how the market works, you understand that now if it happens that I'm a spot trader, I need to understand this concept first. And after understanding, I need to know that once this person has made his intention to sell his assets, definitely the person that I happens to trade that asset at 125 at the price of 125, I would wait. And in the process of waiting, you see, maybe I bought it at 125k. Okay, I bought that particular asset at what? At 125k. And since I bought at 125, the person having it at 118, 120, 121, 122, 23, all these people would think of selling their assets. All these people would do what? Would think of selling their assets. Now, in the case of selling, mind you, I also bought it at 125. So mind you, I'm part of those who bought the assets from these people. Do you understand? I'm part of those people who bought the assets. So those buying the assets here, where are they getting the assets from? They are getting it from these people. Those who have the assets at 118, 120, 122, and 23. They are those buying the assets. So we are buying from these people. They are selling for us. So mind you, the more they are selling, the price will go down again. The price will do what? Will go down. So if it happens, what will change the market is this. If it happens that maybe there are more people who bought the asset at, let's say, 118, let's say 10,000 people, okay, 1,000 people bought it at 118, and then also 500 people bought it at 120, and then also one with the 122 price, maybe 9,000 people or even 100,000 people bought it. Mind you, all these people are selling to make profit on this particular price. All these people are selling to make profit on this particular price. So all of us who bought it at 125, we may drop, the price may drop against us, and that is what we term it as floating loss. In this case, you are floating. And why is it called floating? It's called floating because the market is going against you and you are not making profit. right? So it is called floating loss. So mostly in trading, we have what we call floating profits and then also floating loss. Floating profits and then floating loss. Now, it is called floating because it has not yet become an actual loss. That is the reason we call it floating. Hmm? That is the reason we call it what? Floating. So when we say it is floating loss, it is floated. It is floating because it has not yet become an actual loss. So the nature of the spot market is that a trader floats what? Loss. And also floats profits. So in the case, if let's say I have it at 120 and then the price gets to 125. Now from 120 to 125, I am making profits, right? So if I decide not to withdraw the profit I've made, it is called floating profit. If I decide not to withdraw the profit I've made, since I bought it at 120 and the price at 125, if I decide not to withdraw the profit and it still happens that it keeps rising from 125, 126, 127, 130, I'm in what we call floating profit. Floating profit. So type it in the chat box, floating profit. Floating profits. So floating loss and then what? Floating profits. So mostly traders appreciate floating profits, but they don't appreciate floating loss. But I think right from this lesson, if you now learn to understand floating loss and floating profits, you would understand why you don't need to be worried when you are in floating loss. Give me one in the chat and let me see if the message is home. Give me one in the chat and let me see if the message is home. Give me one in the chat and let me see if the message is home. All right. All right. That is good. That is good. Okay. Now we can proceed. I know my people are learning. I know my people are learning. So let's proceed. Let's proceed. Now, so if you decide to be a sports trader, okay? If you decide to be a sports trader, you need to understand these simple rules or these simple ways the market works. That's the first thing. So once you decide to be a spot trader, you need to learn to understand the rules in terms of trading on the spot market. That's market rises, market dumps. Okay. So if it dumps, what you have to do is, if it happens you fall part of those who happens to buy the assets at its expensive price, you would wait. And mind you, there is nothing like I bought the all-time high. Listen, this word called all-time high, okay, is relative. Because yesterday, listen, yesterday BTC was at 112. Today the price could go to 113. So this person who bought it at 112 may think he bought it at the highest price. But every day the price goes up. Every day it comes down. So the person who bought now present the highest price of Bitcoin is 125. Let's assume 125, okay, thousand US dollars. Now, with this 125 US dollars, there are people who have bought this price, this asset at a particular price of 125. Don't think you bought it at the worst price, because the price could take another peak again and then move from 125 to 130. Mind you, someone will also buy the same asset at 130. Then he would also wait for the price to go to 140. So have you seen how the market works? Now the market could drop from 140 to maybe 110. You see, the market could drop from 140 to 110. This person here will feel the heat of the market. He will begin to think that, oh, what a mess have I caused myself. What a shit, man. Why didn't I wait to buy it at 110? But the question is, did he ever know that the price will drop to 110? Hmm? Did he ever know that the price will drop to 110? And the answer is no. And did this person who bought it at 130 also ever believe that the price would increase to 140? The answer is yes, because price would always go down, demand would increase. So far as the asset is a global asset, the price will surely increase with time. So what makes trading to be different from other forms of business is timing. Time, time. Provided the trader could also learn to understand the language of timing, and time comes with what we call patience. So a trader who understands these two language of timing and patience would always find it so easy to trade on the spot market. Would always find it so easy to do or to trade on the spot market. Now, here lies the case. There is also another form of trader who has studied the market enough, and he has also learned to know that, okay, looking at the market, this is how things have been moving. Now I realize the market goes up, it comes down. So if I have money, I can buy assets at 140, wait to see if the price will go up. Notwithstanding, if the price drops to 130, I should still buy. If it happens that whilst I'm waiting for the price for the 130 to go up, if it happens that it comes to 120, I will still buy. If it happens that it comes to 110, I will still buy. If it happens that it comes to maybe 100, I will still buy. So that is also another strategy in marketing or in trading, which we call the DCA application. That is dollar cost averaging. The dollar cost averaging. Okay, so it's a means or a strategy of buying the assets the more it keeps dropping. Now, what is going to happen? Let's see what is going to happen. The price will now increase from 100 to 110, from 110 to 120, from 120 to 130, from 130 to 140, from 140 to 150, right? Which means if I apply the dollar cost averaging, when this price moves, I'll make profit. When it moves, I'll make profit. I'll make profit. I'll make profit. I'll make profit. So I wouldn't be greedy, pumping all my money on 140, but I'll get a strategy to reduce the price, which simply means if it happens that I'm trading, I'm a spot trader, and the price keeps going up, I'm okay. The price keeps going down, I'm satisfied because I'll still make profits. I'll buy it at a lower price. Do you understand the concept? 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 If you understand, say yes, you understand. So, do you understand the concept? Do you understand the concept? Do you understand the concept? Very good. Very good. Very good. It seems I'm communicating with only three people. Since I'm communicating with only three people here, if you understand, let me know. You understand? You understand? Very good. Very good. Very good. Very good. All right. Good. Good. Now let's proceed. So that is what you need to know about the spot market. Let's talk also about the futures market and see the next thing, how we set up trade, right? How we set up trade. So unlike the spot market, the futures market happens to be an advanced. So the futures market is an advanced market. Okay, the futures market is an advanced market. So you see the spot market, all this while the trader has not lost anything. Okay, because it can keep you. Someone may ask, for how long would I be making the profit? It can be making profit so far as the market is good. It keeps rising. It keeps rising. Or when you buy that low, if the market rise, let's say you bought it 100, you bought here 110, you bought here 120. When this 110 price 100 begins to rise, you make profits. But since the 110 is not yet moving, your profit would only based on the 100, not the 110 and the 120. That is a spot market, right? So it depends on how fast the asset may rise. If it's not rising, you are not making profits. That is the idea. Now, unlike the spot market, when it comes to the futures market, it's an advanced market. Okay, the futures market is an advanced market. Now, traders or experts start to realize that no, we can only depend on this aspect. This means we can also find another way to be making money, because the rule of money is not fixed. There are always alternatives of making money. There are always alternatives of what? Of making money. And some of them, one of the ways is also understanding the futures market. So when it comes to the futures trading, now the rule of trading on the futures market is this. The spot market says bring your money, buy the assets, own the assets, right? Bring money, buy assets, own assets. So if you are a spot trader, the asset belongs to you. Listen, if you are a spot trader, the asset belongs to you. But if you are a futures trader, you don't own the asset. Okay? If you are a futures trader, you don't own the asset. So this is how the futures market originated. That there are people, okay, who have money, okay, and they wish to lend money based on what they have to make money. They have money, they want lending money to make money. So the futures market is also another form of lending market. They loan you, okay? They loan you money. Now, when you go to bank, okay, there are two people at the bank. Someone that is saving money and someone that wants to use his savings for loan. Which simply means when it comes to savings, the money belongs to you yourself, right? The money belongs to you. Now there is someone who is also saying that okay, from the little saving that I have, add more to it for me so that I can go and use that money to work. So if you have $100, you decided okay, I have $100 in my bank account, but then I want the bank to borrow me or to borrow me $100 in addition. Okay, I want the bank to borrow me $100 in addition to my money so that I can make it can be $200 for me to go and win my project, or for me to go and work out my project. In this case, we will say that you borrowed two times of your capital, right? You say you borrowed two times of your capital. So if you go to the bank, you have $10, right? You have $10 and you apply for a loan of $100. How much of your capital have you borrowed? How much of your capital have you borrowed? You borrowed 10 times of your capital. Do you get the idea? You borrowed 10 times of your capital, because 10 times 10 will give you 100. It simply means you borrowed 10 times of your capital. Your actual money is $10 and you went to the bank to borrow $100. So you borrowed 10 times of your capital. So when it comes to trading on the futures market, it's simple. It says that okay, no problem. Maybe you think owning an asset is too difficult. So you like to leverage on us, and that is the meaning of leveraging. I have small. I want to use the small that I have to get something bigger. Okay, that is the meaning of leverage. So, for instance, maybe a boss, a CEO, okay, of a company, because the owner or the CEO of the company cannot do the work alone, he begins to employ people to help him do the work. Since he has employed the people now becomes what is leverage. So, if the CEO is supposed to use 24 hours to do the work, now if you employ five people, now he gets five people in addition, maybe the work can take 2 hours to be done, which simply means he's leveraging on 5 people. Leveraging. So leverage is applicable in most parts of our life. So when it comes to futures trading, the futures market also follows that same rule called leveraging. Okay, so the futures market says, okay, we will sign a contract with you, a contract with you. This contract that we are signing up with you, it's simple. Bring less money. Let's double the money for you to trade. If it happens that you win the contract, you go scot-free. If it happens you lose the contract, we will take your money. That is the agreement of the contract. So the futures market is a contract market, right? The futures market, unlike the spot market, the futures market is a contract market. Am I explaining things in a better way for you to understand? Do you understand? Do you understand? Am I being able to explain things in a better for you to understand? Do you understand? Very good. Very good. Very good. Very good. Good. Let's proceed. Let's proceed. Let's proceed then. So when it comes to the futures market, this is the rule. It's a contract market. And the contract is this. Okay, bring money. Let's double the money for you. Or sign for a loan based on your money. Okay? Sign for a loan based on your money. And based on the loan you've signed, make profits and go scot-free. Or lose and then let's take the money away from you. That is the futures market. So when it comes to futures trading, this is how it works. Let's assume, just like the bank, I have $10 in my account. I said I need 10 in addition, which simply means I need 10 times of my capital, which is 10 times 10. 10 times 10 will give me how much? Will give me 100. Now, maybe I have $10. I said I want $10 in addition. That is going to give me, let's say, that is 10 times what? 5. Or is that not so? Okay, that is 1. Okay, or 2. So that is going to give me 20. Right? So 10 times 2 is going to give me 20. Right? So that is 2x. So in the case, if I go for a leverage, we have different forms of leverage. You have from 1x up to infinity, or maybe some, depending on the exchange, sorry, depending on the exchange. So I have $10. I go for 10x. That is going to give me 100. I have $10. I go for 2x. That is going to give me 20. I have $10. I go for 3x. That is going to give me 30. I have $10. I go for 40. I go for 15x. Right? That is going to give me how much? 150. In that order. I have $10. I want to go for 20x. That is going to give me how much? 200. So it simply means with my $10, I am going for a loan of 200. Someone is also going for a loan of 150. Someone is also going for a loan of 30. Someone is also going for a loan of 20. Someone is also going for a loan of 100. Now, mind you, with this loan that I'm going for, I'm going to use to trade. So when it comes to the futures market, first, it's a loan. Second, what am I going to use to trade? Just like the spot market where we buy low, now the futures market is a contract, which gives you the trader to know that, okay, the market will go up. So on the spot, I have to buy. Or the market will go down. So on the spot, I have to apply my dollar cost averaging to buy more, to buy less of that as same asset. But on the futures market, it says no. Since I know that the price will go up, I am also going to analyze to ensure that the market will go up. So I believe with all my conviction that the price will go up. That is called probability. Probability. I have a chance to ensure that the market will do what to go up. And also I have a chance to ensure that the price will go down. So in the case where I believe that the price will go down, I say I want to short the market. And in a case where I believe the price will go up, I say I want to long the market. So I am longing the market with my $200 borrowed money. I am also lending or shorting the market with my $30 borrowed money. So when it comes to the futures market, this is how the win and then also the losses comes in the futures market. Now, mind you, this is the actual price. So let's take BTC again. Let's take BTC again. Now, the price of BTC is 120K, 125K. There are thousand people. There are thousand people who want to long BTC presently. Who want to long BTC presently. And there are, let's say, 20 people, okay, who want to short BTC presently. This means more people are going to invest money in the long position, which will also ensure that the price will go up. Right? So the price will become very expensive on the contract market. Now, mind you, all these people want to make profits. So those who will long will make the profits. Those who also short will begin to lose because now more people are longing the market and they are investing in expecting the price to go up as compared to expecting the price to come down. Do you understand the concept? If you understand, give me one in the chat. If you understand, give me one in the chat. Let me know if I'm breaking things in an easier way for you. Let me know if I'm breaking things in an easier way for you. Let me know if I'm breaking things in an easier way for you to understand. Very good. Very good. Very good. Let's proceed then. Let's proceed. Now, so you see, more people are now longing this particular market. So since more people are longing, when we say longing, they are anticipation that the price should go up. So they've invested more money to expect the price to go up. This means all the people who went on short will lose. Right? Now, when more people also tend, okay, now let's say 2,000 people are also investing to push the price down. This means all these $1,000, all these people having $1,000, all these 1,000 people expecting the price to go up, they will end up losing. You get the concept now? Do you get the concept? So now there are people anticipating, expecting that the price to go up. So now let's look at the recent happening. Okay, what happened last Friday as an example? The price was up. Okay, the price was up. The market was bullish. So when the price is up, we say it is bullish. When it is down, we say it is bearish. Now the price was up, and one man announced that, okay, now we have issue with China. So because we have issue with China, or China is trying to play smart on the international market, you show them pepper. Okay, you show them pepper. Now this little information caused panic, and more people begin to sell their assets. This simply means there were more people, okay? There were more people who the message caused panic to them and they began to sell all their assets. So let's assume there were thousands of people who longed this particular market or assets. Okay, now there are 10,000 people who lost trust in the market because of the message that the gentleman dropped. Since they've lose interest, they all want to withdraw. Some want to withdraw, some also are having, so in terms of withdrawing, it is anticipation that the price should go down. So the more people are beginning to leave the market, or the more people are with anticipation that things should go down, all these people who went on long will lose the money. And all the people who will go on short will make profit, because now there are more people shorting the market as compared to longing the market. So if more people are shorting the market, the price for those who go on long will lose. And if more people are longing the market, the price of those who short the market would also lose. This is the definition of futures trading. So anytime you lose, you should understand that there are people there are dominant or more people who are on opposite direction. That is one factor. Two, there is someone who has invested more money to anticipate the price to go up, or there is someone who has invested more money to anticipate the price to go down. That is how market goes against you. So while someone is expecting the price to go up, another person is also expecting the price to come down. And mind you, your investment portfolio is very low, right? Your investment portfolio is what is very low. So you have just $100 and you are expecting the price to go down. Someone has invested $10,000 and is expecting the price to go up. Between the two, which one will carry more weight? Between the two, which one will carry more weight? Drop the answer in the chat box. Between the two, which one will carry more weight? Between the two, which one will carry more weight? Between the two, which one will carry more weight? Between the two, which one will carry more weight? Very good. Very good. Very good. So when this happens, now all those ones having the short position would feel the heat of maybe approaching liquidation. Now the next thing is that when it comes to the futures market, mind you, a contrast between the spot and the futures. When it comes to the futures market, now since the market decides to go up, the person or the people on the down would see that the market can go against them. Now the market going against you is based on what you called okay, I'm looking for the right word to be used. Okay, so it will based on your leverage. Now mind you, this person was having $10, then he borrowed money of $100. Another person with $10 borrowed money of $500. Another person with 10 borrowed money of $1,000. Okay, another person with 10 borrowed money of 200, or let's say $50. Now, if it happens that this price, since all people are expecting the price to go up and then more only few people are going down, because you borrow, listen, the higher the money, okay, the higher your borrowed money, the higher your risk. That is it. The higher your borrowed money, the higher your risk. Okay, so immediately the price goes down small. When the price goes against you small, the person with the $1,000 leverage or the $1,000 will begin to the market will begin to wipe you out. That is what we call it, liquidation. You will be liquidated very fast. It simply means if you want to have peace of mind, don't borrow huge money. And that is how it works. Just assume, let's look at the bank. If you are working at the bank, or if you borrow money at the bank, if you borrow huge money, you have to pay huge what we call interest, right? Your interest also increases. The person who borrows less money pays less interest, if I'm right. Right? So in the case of you have borrowing huge money in the bank, no, that's analogy. I think it's weak. Right? So in the case of borrowing huge money in the bank, what will happen is that if you borrow huge money, mind you, you have huge dividends to also do what? Pay, as compared to the person with low borrowed capital. Right? So when it comes to the futures trading, the higher your leverage, the higher your risk. The higher your leverage, the higher your risk. Mind you, the risk is two: the risk of making profits or losing the money. The risk of making profits or what? Or losing the money. So when it comes to the futures market, you are risking to make money or lose money. That is the reason why in the recent happenings, people lose money because they were on the futures market. All those on the sports market, they did not lose anything. Their money is still in their account with the anticipation that the price will go up. Now the question is, how do I trade on spots and also on futures using my Royal Q? Because Royal Q gives the trader opportunity to trade on both spot markets and then also on the futures markets, because we have different traders with risk appetite. So some can trade on the spots, some also prefer to risk good to make good profits. The difference is that on the futures market, you stand a chance of making what you call fast profits. You stand a chance of making what we call fast profits. And on the spot market, you also stand a chance to make fast profits, but at a low pace. Okay? And also on the futures market, the trader can make fast profits, fast and huge profits within a short period of time. So I still use the word fast. So the trader can make huge profits within a short period of time, right? Because the market can easily go up and it can also easily come down. So when the market is going down, the trader can short the market. And when the market is also going up, the trader can also long the market within a short period of time. He will make his profits. So how do I use my Royal Kill? Since Royal Kill is a service provider who ensure that traders can get good opportunities in the market, both beginners and then also advanced traders can be able to use the bot to trade. How do I use the bot to set up a trade on both futures and then on spots? So in 15 to 25 minute time, I'm going to demonstrate to you how you set up your trade on the futures markets and also on the spot markets. If the lesson is well understood, give me one in the chat. If it's well understood, give me one in the chat. If it's well understood, give me one in the chat. If it's well understood, give me one in the chat. If it's well understood, give me one in the chat. Now, mind you, this is just beginner friendly lesson. Beginner friendly what lesson? Mind you, this is just beginner friendly lesson. If you want the advanced session of it, you meet us Thursday. That is where we talk about cross and other sessions of it. Yeah. So if it's well understood, give me one in the chat. If it's well understood, give me one in the chat. Very good. Very good. Very good. Now, how do I set up my trade? Either I want to trade on the futures market or I want to trade on the spot market. So, in brief, within the interval of 15 to 25 minutes, I'm going to demonstrate that to you on your bot. Right? So, quick, let's go to Royal Q. So, this is my crypto apps. So having them here, I have to scroll through, get my Royal Q, and this is exactly my Royal Q app. So this is my Royal Q. Good. Now tap on Royal Q. Right. Okay. Now that I have my Royal Q here, when you come here, we have spots. We have spots and then also futures. So if you are a fan of spot trader, you come here, you click on spot. If you're a fan of futures trader, you click on futures. The first thing that you have to do is to ensure that you've already added all the cryptocurrencies Royal provides to traders. So come here, click on manage and ensure that you've done that. So first click on manage, click on spot, then below click on all, right? All. So you click on that. Let's click on all to see. So if you click on all and you've not added the assets, it will automatically pop up. Then you click on add so that you can add. So in case you search for some assets and then you don't get them, do that. No, not all assets that can appear on the Royal queue, because Royal queue have assets, that is, all these assets are from Binance, though, but not all assets on Binance that are on Royal queue. Take notice of that. So just come and add those ones that you have here. After doing that, go back peacefully, click on futures. Now, after clicking on futures, search for the name of the asset you want. Search for the name of the asset you want to trade. So maybe it's a signal that they gave you, right? So we talk about signal, right? Maybe it's a signal that they gave you, maybe 1,000,000 baby Dodge. So this is it. This is 1,000,000 baby Dodge. Okay, so you just tap on it peacefully. I understand. Then you click on create. Click on create. Create. Okay. So when you click on create, they said cryptocurrencies trading carries high market risk. Please trade cautiously and assess your risk tolerance. Royal Q does not guarantee profits or bear responsibility for trading losses. So, before you even intend to trade, you need to understand that Royal Q does not guarantee profit, because profit is not guaranteed by the general markets, right? So, Royal Q is just a service provider providing you with an automated system of trading, providing you with an automated system of what trading with good trading strategies. That is all. Automation. So pay attention to this message, it is important. Now you click on understand, since you do agree. So I don't remind me again, I understand. Okay, now we said on the futures market, the trader can either long the market or short the market or short the asset. So we have the long and then the short. So selecting long simply means you are with an anticipation that the price will go up, and then also going for short simply means you are having the anticipation the price will go down, right? So if I am expecting the price to go up, I click on long. If I am with anticipation that the price should go down, I click on short. So click on short, click on long, click on short, click on long. You understand? You understand? Very good. Now, after that, you click on this trade settings. Trade settings. Now, if you click on trade settings, we have what we call manually create and then also smart create. Manually create and then smart create. So since I have manually create here, the next thing that I have to do, now we have smart create. Smart create, that is a default setup of the bot. A default setup. When we say default, that is auto, right? So it's a default, that is strategy that has been provided by the bot itself, right? So you click on show parameters, you can see it has given you figures and different entries and call drops. So these are figures you need to add, figures, right, of 1,000,000 baby Dutch. These are the drops to which we'll get there, right? So if you think you prefer setting up your own strategy, you click on manually create. So let's click on manually create. Now, after clicking on manually create, this is your direction. We have choose a template, that is, maybe you have a fixed setup strategy, that you prefer to use. If you don't have a fixed setup strategy, maybe you have to get back. If you have one, you click on it nicely, then you tap on it. But if you don't have one, then the best thing that you have to do is to come here and then start setting up your trade. But most assuredly, the amazing thing on the futures market, unlike the sports market, is that fixed strategy doesn't work here. Why? Because always your first buy amount may not be the same, right? And also, like I've been saying mostly, on futures trading, The volatility, as I explained, that the fluctuations of the asset differs as compared to the spot market. The fluctuations of assets differs as compared to the spot market. So a fixed strategy may be difficult. Why? Because the volatility of BTC is quite different from the volatility of an asset called jelly. These assets mostly behave like a watch. It's hand paper, right? So that is one thing that you need to understand. That's just by the way. Now, after coming here, the first thing that you have to consider is what you can see here, the first buy-in amount. First buy-in amount here. Now, what does it mean? Over here, unlike the spot market, on spot market, you proceed, you enter the amount. If your first buy amount is $100, you enter $100. But over here, you don't see $100 straight. It is given in the form of coin. Now, in cryptocurrencies, every asset carries its value. Now, one Bitcoin is equivalent to 125,000. Presently, is equivalent to 12,000 US dollars, if I'm right. That is 112,000 US dollars, right? So every asset, that is the price of a Bitcoin, right? So one price of a Bitcoin is equivalent to 112,000 US dollars. That is the price of a Bitcoin. So over here, before you can trade on futures, you need to understand the values and how it worked. Also, so in this case, you are seeing 4,294, 1 million baby Dutch is equivalent to 5 USDT. It's equivalent to 5, okay, 0.0007924 USDT, right? Which simply means if I want to trade, how much do I want to trade? Maybe my actual money is $50. And with the $50, I also want to use $10 as my first entry. Now, since I want to use $10 in your exchange, listen, in your exchange, you are using $10 as your first entry. But then when it comes to what we call the position amount, mind you, we said leverage. We talk about leverage. Maybe you want to use 10x. So 10, you want to use 10x. It simply means that if you want to use 10x, your capital is also $10. $10, right? 10 times 10 is going to give you 100, right? It simply means your position amount. When you talk of the position amount, that is the number of your leverage, okay? Your leverage times your actual money that you want to use to trade is your position amount, okay? So let me clean. Now, your actual money is $50, and out of the $50 you have, you want to use $10 to trade. So, and you want to use a leverage of 10x, that is 10x, and 10x times your capital, which is 10, is going to give you 100, which simply means over here you want to see 100 USDT and not 5 USDT. So we need to calculate to ensure that we can get 100 USDT here and not 5 USDT. The easiest way to do this is simple. Take your calculator. Now, since 4,294 USDT is equivalent to 5 USDT, if I want to get my 100 USDT, this is what I'm going to do. This is a simple calculation I will do. Are you following? 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 Very good. Very good. Very good. Very good. Very good. Now let's proceed. Let's proceed. Since you are following, let's proceed. Since you are following, let's proceed. Right? Since you are following, let's proceed. Okay. So this is it. Now, since we are using 10, Since you are using 10, okay, where is it? Okay, since you are using 10 times your leverage, which is 10, that is going to give you 100, right? Good. So I just have to take my calculator. 4294 divided by 5, okay, times 100. Apart from the hundred is my capital times my leverage. That is what gave me 100. So that I can get the value of a million baby Dutch, because 4,294 gives me 5 USDT. So how much of a million baby Dutch, how much million baby Dutch will give me 100 USDT? That is what we mean. How much, if 4,294 gives me 5 USDT, how much will give me 100 USDT? Do you understand? So I take my calculator. Since 10 times 10, where did I get the 100? The 100 is 10 times 10, which is 10 times my 10, which is my leverage times my actual capital, which is 10. So I take my calculator. Let's go. So 4,000 what? 294. 4294 divided by 5 times 100. That is going to give me 85,880, right? 85,800 and what? 80. So 85,880. So I will just come here Nicodemously, come and delete this and enter 84,580. And that is giving me 98. Maybe there is a less miscalculation because we didn't bring the decimals, right? So let's assume increasing the number to 84,500 and gosh, instead of 580, let's see, 589. Let's do the calculation well. Let's get back to do the calculation. So 4,294, right? Over here it was 4,294. That gives us 5.00 USD. So let's try to bring the decimals and see. 5.0079. So 5.0079. So 85,744. So 745. Let's run it. 85,745. Okay, and that is giving us approximately 99.85 something, which is exactly 100. So we can run it up to 6 or 7, and let's see. Wow, what about 50? Ooh. All right, so please, I guess running it up we are going to get that value. Okay, running it up we are going to get that value. So what are we communicating here? What we are saying is that at the end of the day, we want to ensure that the value that we have here, we need to get a value that will give us 100 USDT as we want it to be. And 99.8 is equivalent to 100, right? But we should ensure that at least we can get a match value of 100 point something. That would be okay. Or better still, 99.89 is also okay, right? So it simply means 8,576 million baby Dutch is equivalent to 100 USDT. Is equivalent to 100 USDT. So immediately an asset or a signal is given, I have to come here, then I come to my take profit. Based on the take profit I want, or the signal or the analyst is asking me to do, I do that. Then my callback. So when we talk of the callback, we have buy in callback, and then also where is it? Okay. So we have hold position take profit callback, and then also buy in callback, as well as distributed and start position take profit callback. So when we talk of the take profit callback, we mean to say that when the assets rise, when it rise to a profit of 1.1% and drops 0.01%, we should our trade should trigger for a profit of what? 1.1%. So the rise and then the drop will give us our take profits, right? Because an asset, the market rise and falls, it rise and falls, it rise and falls. So as the market goes, if it rise and then have a drop of 0.01%, we expect our profit to be triggered on 1.1%. That is the meaning of the call drops. So over here, when you come, we have our take profits callback, which is 0.1 or 0.01. So let's go for 0.1, 0.1, and then 0.1, 0.1. Now, the next thing, we come here, we click on advanced settings. Advanced settings. On advanced settings, that is it, advanced settings. So click on advanced settings, click on optional. When you click on advanced settings, you are going to see this. We have one shot. So we have cycle and then one shot. Now, when we talk of cycle, if I place the trade on cycle, it simply means when a trade is sold out of the market, you should buy again for me using the same setup. If the trade is sold out of the market, you should buy the same for me using the same setup. Now, mind you, this is somehow dangerous because the market, on the futures market, unlike the spot market, on the futures market, you see trend changes with time, within a short period of time, and it can matter when things changes, it can trigger your liquidation. So if you are not careful and you decide to place your trade on cycle without having any mental alertness, or being aware of the decision you are making, it can trigger liquidation. If it happens, the market turns against you. Especially, let's assume that you go on long and then the market reverses to short, right? Now the long trade is already sold. Once the long trade is sold, the market is reversing. And here lies the case. In your case, you still went long instead of going on short. You see, you'll be liquidated. So you always need to be careful anytime you decide to place your trade on cycle. So we have the one shot. Now, the one shot, once the trade is sold, you get opportunity to buy a new asset based on your personal decision, right? Based on your personal decision. So that is a quick way of setting up a trade on the futures market. Now let's look at the configuration. How to configure, use the margin configuration as well. How to use the margin configuration. So over here you set up a trade. This is your trade. This is your first buying amount, that is 100 USDT. Now this 100 USD simply means that in your exchange you are using 10 USDT. This means you are using 10 USDT to trade, and not necessarily 100. But because of the leverage that you borrowed, that is the reason why you are seeing 100 here. So every profit you make, if you make 1.1, you are making the 1.1 on the 100 and not your 10. If you make every single profit you make, you are going to make it on your 100 and not your 10. And also, when you lose, you are going to lose the $10 in your exchange. When you lose, you are going to lose the $10 in your exchange. If that is clear, give me one in the chat. If that is clear, give me one in the chat. If that is clear, give me one in the chat. Hey, if that is clear, give me one in the chat. Okay. All right. All right. That is good. That is good of you. That is good of you. You're following. That is good. All right. Let's proceed. Let's proceed. Very good. So now, when it comes to the futures market, the first thing that I've been saying is that, especially you've analyzed the market, or you couldn't analyze the signals yourself and you picked a signal elsewhere. Now, when we talk of signal, okay, When we talk of signal, that is, in other way we may call it a prompt. Okay, a prompt. Now, signal in trading is important. It's just that you've analyzed the market. Hmm? You've analyzed the market, right? You realize that okay, BTC to go up. So the price is presently 112, and it will go to 100 and maybe 12, 112 from 112 to 113, let's assume so. So within this range, you are anticipating to trade within this range. So you've given yourself signal. So your signal is that your prompt is that price will move from 112 to 113. In this case, maybe you are not good at analyzing, so someone has analyzed. So for instance, on our platform, we have signal groups where we can opt for signals. So let's see, for instance, this is a signal group. We have the one world signal group. So let's look at some of the signals that has been dropped. Let's look at some of the signal that has been dropped. So for instance, we have this signal here, that is RDNT, that is asking us to short. So this one, you go straight. Now, for instance, we have this particular signal here. Where is the okay? We have this particular signal here. Now, what is it communicating and how do you set it up? First, so quickly, let's do that. Now, it said futures signal. So it has given the indication not spot, but what, but futures, right? Now, this is the name of the asset, that is XNX. So you have to take notice of the asset XNX. It said current market price. So sometimes you may not see current market price, you may see CMP. CMP simply means current market price. So when we say current market price, so for instance, let's come here. So so let's go back. So let's search for the name of the asset. Quick. Let's search for the name of the asset. So it said XNR, right? This is just a demonstration. XNX. Okay, this is it. Wow, look at this. Look at the way it's pumping. So let's go. Create. They search long, right? So first, check what it's telling you to do. It's important. Check what it's asking you to do. So come here. They said what? Long position. Long position. So they said trade it at current market price. This is the current price of the asset. This is the current price. Now, you see the price keeps changing, which simply means if you delay like 3 minutes, the price will change. So if it happens that it was 2.180 and now look at it, maybe the price changed from 2.180 to 2.1 or 2.2. Let's assume 2.2. You see, all those trading this particular price are okay, but all those who entered here, these people would surely go out of the market before you due to the indifference. So look at it. Have you seen how it's jumping from 1.8 to 2.2? And you know, within this range, someone might have hit profit long time. Someone might have hit profit because he's using leverage. In the advanced session, we talk about how leverage affects your trading results. So I wish Thursday you would also join the advanced session. This is for beginners, right? So over here, they said use current market price. So you are trading the price within the few range, which means you are not supposed to delay even 3 minutes. 3 minutes is too much. So quickly you come to trade settings. Since they ask you for long, you click on this. Now you come here, you decide on the this thing to use your leverage, maybe 10. Then you come here, they take profits. Let's look at the take profits. That the signal owner, that is 1.5. This is the take profits. Okay, TP. That is take profits, right? So quickly 1.5, you come here, you enter. Now, the fact that the analyst is saying 1.5 does not mean necessarily enter 1.5. You can decide to reduce it. Since maybe you even enter late, maybe that 3 minutes you couldn't enter within that same zone. So instead of going for 1.5, go for 1, so that you can also reduce. Because the higher your take profit, the more you can also be delayed in the market, right? That is the idea. So over here, quickly, you change everything 0.1, 0.1, 0.1. Sorry. Then you check your this thing, change from one shot to cycle to one shot. Now, let's look at the next thing. What again should we change? Coming here, they said, okay, use whole warehouse mode. They said, okay, use whole warehouse mode. Then the next thing is drop. So they said use small first buying amount. It simply means your entry price should be less. Don't use too much. Don't trade after 2 minutes. Do not trade after what? After 2 minutes. That is what the analyst is asking you to do. So quickly, you proceed. Now, the first thing, even before you think of open margin calls, first activate the trade. So click on save. Now activate the trade. After activating the trade, after activating the trade, so let me activate this. I'll still have to delete it, right? So after activating this trade, the next thing that you have to do, I'll close it in loss, don't worry. After activating the trade, you proceed quick. You go to your margin configuration. Margin configuration. Now you want to set up margin calls for this particular one, this particular trade. You want to set up margin calls for this particular trade based on your capital. Based on your what? On your capital. Now, why the margin calls? Why the margin calls? The margin calls is there for you to get access to buy the assets at lower prices if it happens it's going against you, right? If it happens you get the opportunity to buy the asset. If it happens the market is going against you, it should buy the assets at a lower prices for you, but in order for you to make profits on that asset, right? Okay, so now another aspect of buying margin cost is that the margin cost also creates what they call average prices. Average prices. And when we talk of average prices, that is a new rate at which you buy the asset, or a new price at which you buy the asset becomes your average price. So the more you buy the margin cost, the more it creates new average price for you. And when it comes to trade settings, what I've been saying is that margin cost does not have fixed formula, right? Mind you, the analyst says use three less than, not greater than, sorry, not less than 3 drops, right? So at most maybe 5 drops, and you decide to use 10. Well, that is your choice, right? Another person to also decide to use maybe 5, 6. That is your choice. Now, what makes this place to work so far so good? Let's look at how to calculate this aspect, the multiple buying ratio. Let's look at how to do with the multiple buying ratio. So let me quickly close that fucking trade since I've not analyzed it. So let me close it sharp. So this is how to close a trade. In fact, to those of you who want to know how to close a trade, maybe you want to close a trade in loss, or you want, if it's in profit, you want to close it, just tap here. Once you tap on it, tap on close. This is close. So if you click on close, when you click on close, this is what you are going to see. You are going to see, please enter trigger price and also market price. Don't click on the enter trigger price since you want to close the trade. Click on the market price. So click on market. Once you click on market, click on 100%. 100%. After clicking on 100%, you can see this is the loss, the amount of money you are going to lose. So just tap on it nicely and then close the trade. Click on confirm. Confirm to close what? The trade. So confirm. Very good. After that, you can see the trade does not exist, right? You can see the trade does not exist, right? Very good. Since the trade does not exist, now you can proceed. You talk about the margin calls, then I give you the opportunity. You spend almost an hour, 30 minutes here or 2 hours. So when it comes to the margin calls, mind you, this is margin calls, your multiple buying ratio. And when we talk of the multiple buying ratio, it's asking how many times will you prefer to buy the asset? How many times will you prefer to buy the asset? How many times will you prefer to buy the asset again as the market keeps dropping against you? How many times will you prefer to buy the asset as the market keeps dropping against you? Right? So you will decide based on your capital. Based on your capital. Now, margin call is not a fixed something that you need to, because you may have different capital allocated for your trade. Maybe your capital is $100. Out of the $100, you use $10 as your entry price or entry capital. You have $90 there. If you wish to use all the $90 to continue that same trade, then you come here, you open the margin calls based on your capital that you have. Now, mind you, we set margin calls. How do you do that? First, how many margin calls do you want to open? Maybe you want to open 10 margin calls or 5 margin calls. If you want to open 5 margin calls, this is a simple thing to do. If you want to open 5 margin calls, this is a simple thing to do. Okay, so please give me a minute. It seems I have to do this. I can see the power is draining. Guess, are you guys following? Let me know. Are you guys following? Are you guys following? Are you guys following? Are you guys following? Are you following? All right. So can you proceed? Okay, let's proceed. Let's proceed. Let's proceed. Let's proceed. All right. So now that is the last thing. Then I will give you the opportunity to ask few questions. Maybe your questions will also take time. So when it comes to the margin configuration, it should always be based on your capital, right? So you have $100, someone is having $200. Your entry should always be different. Your margin cost is also different. So when it comes to the margin cost, it's simple. Now, how many times will you prefer to buy these assets? If you say 2, 4, 8, 16, 32. Why this? The reason why these values are here is simple. Now, if you get the opportunity to buy that first asset at a lower price, the next thing is if you can buy more of the same assets, it can increase your average price, which can also reduce the rate at which the market is going against you. Now, mind you, let's assume this. You bought $10 at the first time. Now, you've been able to buy $50 at the second time. Looking at the weight at which you bought the first asset and then the weight at which you bought the second asset, could the market easily go against you? And the answer is no. That is the reason why having this here, you can see we have 2, 4, 8, 16, 32, right? 64, 128. Why? Because if you can be increasing, okay, the value with time, then it will be very difficult for the market to go against you. Because let's assume now The market drops 3.5%. You bought 2 times of your first buying amount, which is 10, right? Which happens to be, so 10 in your actual exchange is 10 in your position amount, that is going to give you 100. So it simply means the next one that they are going to buy, it's going to be 200, which is 20. Now, the next one, which is 400, okay, 400, right? The next one is going to be 800, which is 2 times the first asset. Mind you, when I am talking about 800, because your first amount was 100, okay? So 2 times of your first amount, 2 times of 200 is going to 100 is going to give you how much? 200. 4 times of 100 is going to give you how much? 400. 8 times of your amount is going to give you 800. Do you get the idea? So 800, the next one is going to be 1600. So mind you, when we say 200, 100 simply means 10, 200 means 20, 400 means 40, 800 means 80, 1600 means 160. So it simply means in total, from the first to the fourth call alone, you need, let me clean this. Let me clean. You need 200, 400, 800, 1600, which is, in an actual sense, 200 is $20, 400 is $40, 800 is $80, and then $160. Do you get the idea? So 20 plus 40 is going to give you how much? It's going to give you 60. So this plus this, let's assume this plus is going to be 200. So in total, it's going to be $300, right? If I'm right, 300, that is 200, 100. That is going to give you $300. So in total, $300, right? That is what is going to help you to buy from the first to the fourth call. Using what is written here, the value that we have here as 2, 4, 6, 8, 16. 2, 4, 8, or 16. That is the value having here. That is going to give you a total of $300. So if you don't have $300 from the first to the fourth call, you can't afford to buy. Now, why this? Because this is going to help you to ensure that you reduce the risk at which the market will go against you. Because let's assume I bought $10 first. Okay, I bought $10, and now the market is going against me, and I've been able to buy $40. You see, I've created a huge distance. If I'm able to buy $80, I've created a huge distance again. The gap becomes so increasing with time, and the more the gap increases, the more I build the gap within what liquidation. If you understand that, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. Okay, someone saying no. Someone saying no. Someone saying no. Someone saying no. Okay. So, well, say, can we have video on how to set trade on both sports and futures? All right. So you are here. You are still seeking for video. Anyway, let's proceed. Now, what we are saying is simple. What we are saying is simple. Margin configuration, your multiple buying ratio. And we are saying what can help the trader, especially on the futures market, and this is applicable both on the spot and futures, is that the more you can increase your buying amount, the more you can sustain in the market. And that is when you can also remain profitable. Why? Because let's assume $10, you expose $10 in the market. Now the market is going against you. You expose another $20. you expose $40. So the more the market goes against, the more you expose higher amounts, right? So looking at this here, they said 2 times, 4 times, 8 times, 16 times, 32 times. What it means is that when you say 2 times, that is 2 times of your first buying amount. What was our first buying amount? 10, which is 100. Okay, when I say 10, I mean 100 because in our exchange it is $10 and then in Royal Care it is 100, right? Good. Now over here they said 2, that is 2 times your first buy amount. What was your first buy amount? That is 100. So 2 times 100, that is going to give you 200. Now when the market is going against you, the more you can increase your buying amount, the more you can sustain in the market to remain profitable, right? So if I can be increasing, so if it happen that I have to buy 1, this time I'm going to buy 3. So I'm tripling my amount to be bought. That is the meaning of the martingale. So when it comes to martingale strategy, this is martingale. So for instance, the martingale strategy is mostly a tripling effect of mathematics. So let's assume I have 3. If I want to increase my sustainability in the market, I need to multiply my first amount by 3 again. That is times 3. So the next one, that is going to give me 9. So it simply means I'm going to have 9 to buy again. Times 3 again, that is going to give me 27. Times 3 again, that is going to give me how much? 81. That is martingale. So the martingale strategy that we've been using does not follow the effect of maybe 1, 1, 1, 1. It's because mostly we don't have more capital. But if you have more capital, the tripling effect can help you to make more profit. Because if I buy first one, if I buy 1 time in the market, the next one I'll buy 3 times of the same assets. The next one I'll buy 3 times again of my next amount, which is 9. The next one I'll buy 3 times again, which is 27. The next one I'll buy 3 times again, which is 81. Do you get it? So the more I increase my wins in the market, the more I can sustain in the market. If you understand, give me 1. 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 So the question on, please leader, are we still using leverage to do the margin calls? Now the leverage is important because now listen, if it happens, that, mind you, 100 in your exchange, sorry, 100 in Royal Q means 10, right? So if I come here and I say I want to buy $10 again, it simply means I'm buying $1, which does not add more effect in your capital. If I say I'm buying $5 in Royal Q, in my exchange, that is not $5, that is 0.5. Do you know why? Because 5 divided by 10, that is my leverage. Let's see, 5 divided by 10. Divided by 10, that is 0.5. Very good. So it simply means in my exchange, I'm using 5, not oh. In my exchange, I'm using 5 and not, sorry, I'm using 0.5 and not 5 itself. So if you want to use 5 in your exchange, that is going to give you 50. So in calculating your margin calls, it also matters a lot. Mind you, I'm not teaching you a fixed formula. I'm teaching you how to go by things yourself. That is how I teach. I'm not teaching you a fixed formula here. I'm teaching you how to calculate things yourself and how things works, right? And in the advanced settings, I would elaborate, especially on the issues of cross margin, isolated margin, um, stop loss and not stop loss. I will elaborate all those sessions if God permit Thursday. So if it happens that you use $5 here, if you say you are buying two of your first buying amount, your first buying amount was 100, which happens to be $10 in your exchange. So if you say you are buying 2 times, which is 200, in an actual sense, it means you are buying 20. If you understand, give me one. If you understand, give me one. If you understand, give me one. Which video are you talking about again? Okay, so I don't know the kind of video you are talking about. We are having live training. You are still talking about video. Hmm? Timo link or whatever. We are doing live training. This is live training. You are here with us. We are still talking about video. Unless maybe you're talking about the YouTube channel. The video is being recorded. The session is being recorded. As you can see, this is it. It's being recorded and it will be dropped to be updated on the YouTube channel. So don't worry. Now, let's look at. So let me see. I saw a question here. So as a beginner, how much do I need to have in my futures trading account? Can I trade futures with $5? And of course, you can trade with $5. I am trading on spots. Can I still trade on futures at the same time? Yes, you can do that. I'm asking because of liquidation. Hope it will not affect my trading capital on a spot trading. And the answer is no, it will not affect it. All right. So let's proceed. So at the end of the day, yeah, Royal Q Revolution. So you can go to YouTube, you can type Royal Q Revolution and you'll see the channel. You can type Royal Q Revolution, whatever session that we've done, it's recorded there. So you see it's there. So what we are saying is simple. I'm teaching something not because I have this is a strategy, but then this is how you can go by creating your own trading techniques in the market. I've told you that you are not a bot. You are a human being who reasons. And since you have the ability to reason, you should always learn how to navigate things by your own way to make profit. So over here, it's simple. The main purpose of this margin course is to ensure that you can sustain in the market and also remain profitable as the market goes against you. That is the main purpose of the margin course, right? So that you can buy more in the market. And if God permits, on our advanced settings Thursday, I will take time to elaborate more on whatever we've discussed here. So I wish you would join the advanced session. This is beginner friendly, and I believe it was more helpful. Ask question if you have any question to ask. Drop your question in the chat box. Let me use few minutes to answer your questions. We spend almost 7 o'clock Ghana time or 7:30. Let's assume 7:30. So we spend almost 2 hours here. So if you have any question, drop your question in the chat box and let me use this opportunity to answer your question before we depart. And today is Monday. As traders, our responsibility is to trade and make money. So mind you, may not win all trades. Our response on the futures markets, you can't win all trades. Definitely, some of the trade may go against you, but in as much as it's going against you, you also need to understand what we call market psychology, to which maybe in advanced class we will discuss about that too. So please ask your question. If you have any question to ask, and let's see how we can assist or how best you can provide possible solution to your problem. So um, okay, so I have this OG here. And it has been, I think, we traded this on Saturday. It has been here for how many days now? Okay, 1 day, 12 hours. Okay, so this OG has been here for 1 day and then 12 hours. Okay, which is getting to. So now, as you can see, we have the liquidation price. Maybe these are not even, this may be for advanced class. So we have the liquidation price here. Now, if it happens you want to close this particular trade, you click on close, right? Now, mind you, the market is just against me 1%. 1%. And 1% here simply means $32. So if it happens that the market rise 1%, this is the exact profit I'm going to make. Do you understand? If it happens that the market rise 1%, this is the profit I'm going to make. And in same manner, if the market goes against me 1%, this is the losses I'm making. Right? And this happens to be my take profit. My take profit is 1.5%. right? My take profit happens to be what? 1.5%. So over here, if I want to close this trade, I just tap on close. Now look at the trade. This is the average price, the price at which I bought the assets. Okay, the price at which I'm trading. I traded this particular asset. It was 16.170, and now the price has risen from 16 to 3 point what 1, 3.1, right? Good. So if it happens I want to close this trade, I just tap on close. I click on market. I click on what? Market. Now I click on 100%. If I click on 100%, this is the money that I am going to lose. That is $30. I'm going to lose $30 out of the trade, right? Then I click on confirm. I click on confirm. And since I'm not ready to lose this trade, I'll have to leave it, right? And mind you, patience always matters in trading. Now, as of yesterday, I was around negative 250, negative 250, and this morning you can see negative 28. And mind you, in advanced settings, we talk about hedging too, hedging. And I've hedged this trade to make good profits here. I've hedged this trade to make good profits. So you should always learn to exercise what you call patience in trading. You should always learn to exercise what you call patience in what in trading. That is another key way to grow in your trading journey. So if you have any question, let me see your question in the chat box. Let me help you. I can see people are calling me, and I have to. Yes, that is Thursday. The advanced session is Thursday. Thursday. So you prepare yourself to join us if God permit. Thursday. Prepare to join us if God permits. Thursday. All right. So, mhm. All right. So please, if you have any question, all right. So I said hedging will be taught in the advanced class. How to set up sports trading. How to set up sports trading. So in the case of sports trading, I guess it's the same, right? What changes is this? What changes is this? So this is it. Now, okay. So this is it. Now, for the sake of the person who asked of the hedging, okay, if it happens you want to hedge a trade, let me briefly do that. If it happens you want to hedge a trade, you click on create long strategy because I'm on short on this particular asset. Okay, I'm on short, so you click on create, then it's already on long. Automatically it will be on long, so you click on trade settings. Now you decide on the amount of money to expose to the market. You decide everything is set already, so you proceed. Then if possible you want to make entries, you decide on the take profit to be used, then you proceed. You click on save, click on save, click on activate. So immediately you click on activate, the trade is automatically hedged. This is the hedge trade, right? This is the hedge trade. So since you have the trade here, automatically you have to leave it on to make profits, right? So if it happens, mind you, when you hedge a trade, if this one goes down, this one the market will go against you on this. If it happens the market is right still going against you, this one will be in profits. That is the meaning of hedging, right? That is the meaning of hedging. So that is the idea. Now, in the case of spot trading, I'll get back to close it in profits. Don't worry. In the case of spot trading, if you want to trade on a spot, just as we also trade on a futures market, that is the same. You click on create, understand. You click on create, then you select math angle, then you click on create, understand, trade settings. Mind you, unlike the futures which has got long and short, the spot is not like that. So you click on manually create. So you come here, you see it's the same, okay? It's the same. So just the first buying amount that has to do with stress, which is not there. So over here, when you come, you can see this here we have first buying amount. So if you want to use $100, you enter straight away. Unlike the first one that you have to calculate. So $100 straight away, right? So that's wasting my time. So you proceed, and everything remains the same. Everything remains the same, right? So this one 0.1, 0.1, 0.1. That is it. And then you change your advanced settings, you change from cycle to one shot. That is all. Everything remains the same. Then you click on save. So that one, so if you have any margin configuration to open, just as we did for this one, the same strategy is what you are going to use to trade. That is all. So guys, I believe you can also follow the same process to trade. And I believe this morning session has been impactful. You've been able to learn something new. It has really helped you, and it's going to help your journey to grow. So come again on hedging. Well, I guess for hedging, we've been discussing this. Auntie Kate, hedging is this. If you want to hedge a trade, you guys have already made me do by force hedging. Hmm? By force hedging. This is called by force hedging. Hmm? Meanwhile, I'm expecting this particular trade itself to drop. So I've already hedged the trade. Now, this is what you can see. This one is on short. And hedging simply means if it's on short and I've gone on long, simply means I'm expecting this one to rise. Right? So when this one goes up, this one will be in losses. When this one goes down, this one will also be in losses. And you can see it is going down. It was around negative 35. Negative 35. And since it's going down, this one will also be in losses. That is the meaning of hedging, right? So in advanced class, if God permits, Thursday, don't be in hurry to learn. Let's learning be a gradual process, a progress. So if God permits, Thursday we shall meet again to in advanced class to learn more about the trading. So guys, I believe we will end here. Since there is no question, we will end here. If God permits, we shall meet again Thursday. I wish you all the best and do your possible best to go on YouTube. If you don't understand anything, go on our YouTube channel, go and watch all the tutorials there and be guided, right? Go and watch all the tutorials there and be guided. If you don't understand anything, the platform is always there. Always learn to work with your leaders, ask them questions, do the needful, and also stay careful in the market. Mind you, do not be greedy. Do not be greedy. So I urge you that you should be careful trading and do not give heed to scammers, right? Whoever tells you there is a new platform, run away. Run for your life. Let's learn how to trade and take our destiny in our own hands. And I believe we shall surely succeed in this trading industry. I wish you all the best in your trading journey. And also, mind you, it's a brand new day and you have all the opportunities. We all have the same minutes, we all have the same hours, we all have the same seconds, and we can all do greater things in our life, right? So do not look back on what has happened yesterday. Focus on today because today is the only day you have, and that is what is going to build your tomorrow. So focus on today and make sure that you can become the best version of yourself today so that tomorrow you can be the best among all the best. All right, so ladies and gentlemen, we will end here and I wish you all the best in your trading journey. Have a good day. Love you all. Bye 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 bye.